Good day and welcome to this question clip. It is on chapter 5 and it deals with liabilities, long-term liabilities, and then the short-term portion thereof. The question that we're going to deal with today is the question of Hettie Kesnie. And if we read the required part, it's two sections, A and B. In the A part, they ask us to show the following general ledger accounts in the books of Hettie Kesnie for the financial year 1st of March 20.6 to 28 February 20.7. Financial year dates, always important, and when we draw up our timeline, that will have to be two prominent points on the timeline as well. We have to properly balance or close off the accounts, and the three accounts that we have to prepare is the interest expense account, the accrued interest account, and the long-term loan. So in preparation for your answer, you can draw up the frameworks for the interest expense. That's an equity account. So it will increase on the debit side so that it can decrease the equity. Accrued interest, if we pay interest in arrears, we will end up owing the bank more interest. So this will be classified as a liability, therefore increasing on the credit side and decreasing on the debit side. And the same rule will apply for the long-term loan, which is also a liability with an increase on the credit side and a decrease on the debit side. In the B part, they ask us to show extracts from the statement of profit or loss and other comprehensive income, statement of financial position, and then notes of Hettie Kesnie that indicate how the interest and the loan will be disclosed in the financial statements, again for the year ended 28 February 20.7. So that is the same date as the T accounts that we're going to draw up at the start there. While you're reading the required part, just get your thoughts sorted out about which amounts will be disclosed in which of these statements. For the statement of profit and loss, that will be our expense incurred. So for that, we're going to look at the interest expense account. Then they ask us for the statement of financial position. Statement of financial position is for the assets and liabilities. So the accrued interest, which is a liability, and the long-term loan, both of those will influence our statement of financial position. So for this one, we will look at the interest accrued and the long-term loan. Then for the notes of Hettie Kesnie, you have to remind yourself of the 4 items for a loan that you have to disclose so that the users can make informed decisions. The 4 items is the nature of the loan, whether it's secured or not, the repayment terms, and then the interest. Interest, we will also have to stipulate whether it's market related or not. So while you read through the required part, you know what to look for in the given information. If we can now start reading, they tell us that Hettie Kesnie borrows 250,000 Rand on the 1st of January 20.3 from Lotto Bank. The loan is repayable in 5 equal annual installments, of which the first is payable on 31 December 20.5. When you get to this point, there's a lot of information. 5 equal annual installments with a date of the installments and a date that the loan was acquired. So to order our thoughts, we're going to make use of a timeline to include all this information. The time that you spend drawing up the timeline will be saved in your calculations in the required part. So let's quickly have a look at our timeline. The 2 important dates that you first have to draw up is the start and the end of the financial year. So in the required part, they already told us that we have to draw up the accounts from the 1st of March 20.6 until 28 February 20.7. So those are the 2 important dates, and now we can plot this information on the timeline that we started. Hettie borrows 250,000 on the 1st of January 20.3. So that's before the start of my financial year. So I'm going to make an indication here for the 1st of January 20.3. That's when I borrowed the money, 250,000. Remember, for this loan, we're going to have a capital line on the timeline as well as interest, because we're going to have to deal with both the outstanding amount and the interest. So this is when we borrowed the money. Then they tell me that the loan is repayable in 5 equal. That means you take this 250 and you divide it into 5 equal parts, giving us 50,000 Rand as an installment. This is annual installment, so annual implies 12 months apart, of which the first is payable on the 31st of December 20.5. So we again have a date, and we plot that on our timeline. It's just before the start of our financial year, 31 December 20.5. And over there, we're going to pay our first installment. So that is the 50,000 that we calculated, the 5 equal annual amounts. If this is annual, 12 months from this date will be the next installment payment, 31st of December. And then you also include one installment after the end of the year. The reason for that is the distinction at the end between current and non-current. So we're also going to include another installment payment, and that will be for the 20.7 here. This is 20.6, 31 December. Interest at a rate of 12% per annum on the outstanding capital amount is paid half yearly every 6 months. It's payable in arrears on 30 June and 31 December. Now, please don't make your picture include interest payments from the date that you obtained the loan. That's why we have these two prominent lines. So we're just going to move about these two lines and not go into the past too far. So they're telling us that we're paying interest on the 30th of June. So 30th of June, we have an interest payment. And then on the 31st of December, we have an interest payment. Go one interest payment prior to the start of the year, and again one interest payment after. Because they tell us that we're paying in arrears, it's important to look at the last interest payment. If it's in arrears, we're paying for past use. So when we get to the start of the year, there was still an outstanding amount, just so that you can do that calculation a bit easier. Then they tell me the long-term obligation is secured by a first mortgage bond over Hettie Kesnie's land and buildings. That is for the disclosure purposes. Remember, we reminded ourselves of the 4 items, which includes whether it's secured or not. And the carrying amount of the land and buildings is 200,000 on 28 February 20.7. So at the end of the year, they also give us the value that serves of the assets that serves as security for the liability. Now we have our timeline, and we can use the timeline to draw up the accounts that was required. We start at the start of our financial year, because that's the time that we have to prepare the financial statements, and we determine 2 amounts. We determine what do we owe them in terms of the loan. So that was the 250 minus the 50,000. So in our long-term loan, we can start off with our balance on the credit side as at the start of the year. So that is the 1st of March 20.6. We have a balance of 200,000. Then we also need to determine at the start of the financial year, did we owe them interest or have we prepaid the interest? Now that's why this last interest payment was important. If we pay in arrears, that will imply that we still owe them interest for this period of time. Now if you count the months, it's from the 31st of December until the 1st of March, so it's only January and February. So that means that we've still owed them interest for 2 months. For that 2 months, I need to calculate the outstanding interest. So I'm going to take my outstanding capital amount, which is 200,000 Rand, multiplied with the interest rate, which was given as 12%. For the period of 2 months. So your first calculation for the interest is the interest that was due at the end of the previous year, and that amounts to 4,000 Rand. So our adjustment at the end of last year would have resulted in an accrued interest. So I start with a balance again on the 1st of March 20.6. A balance in this liability of 4,000 Rand. That was at the start of my financial year. Now the first transaction that you have is on the first day of the start of the new financial year, where we have to reverse last year's adjustment. I'm going to explain to you now why this reversal is necessary, but the reversal will result in the liability being transferred out of the liability account. So we're going to debit the accrued interest, and for every debit we need a corresponding credit, and that will end up on the credit side of the expense account. Interest expense, and this will be from the accrued interest. Like I already discussed, this is the first entry for the new financial year. I just want to make an indication here that this is the reversal of the 2 months that we had as an adjustment at the end of the previous year. So this is for 2 months. If we now carry on our timeline, the first transaction that we have is a payment of interest. Now, in accordance with the agreement that you have with the bank, they told you that you're going to make half-yearly payments. So you're paying every 6 months for the previous 6 months. This has nothing to do with your accrual concept. Remember, the bank does not know your financial year end. So the cash payments is in accordance with the agreement that you have with the bank. So if we get to the 30th of June, we're going to make an interest payment for the previous 6 months until the last interest payment in arrears. So our calculation of this interest payment will again be on the 200,000 Rand at the interest rate for 6 months. That gives me an interest expense of 12,000 Rand. If we pay, that will influence our expense account. On the debit side, 12,000 Rand. I paid it with cash, and this happened on the 30th of June. If you now look at your accounting entries, if this was a payment for 6 months, how many of the 6 actually belongs to this financial year? Of the 6, only this 4 months belongs to this financial year. And that's why we had the reversal of the 2. Because if you take this payment of 6 and I deduct the 2 months that I reversed, I'm left with 4 months of the current financial year. So according to our debits and credits, our accounting entries, we change this from the cash concept to the accrual concept by means of this reversal. So at this point, we are happy that 4 of these 6 actually belongs in this interest expense account. Now we can carry on our timeline. The next thing that happens, we make an installment payment of 50,000. So that installment influences the loan. So we're going to go to our long-term loan and deduct the 50,000 on the debit side. We pay this with cash, so that will be bank, and that is on the 31st of December. That's not the only thing that happens. We also pay interest, and if we pay interest for past use, we're paying for the previous 6 months. Can you see that is prior to this installment being paid? So we still owed the bank the 200,000. We cannot deduct the 50 because we're paying for past use in arrears. So my interest calculation will again be 200,000 at 12% for 6 months. So it's another 12,000 Rand that I have to pay in my interest expense account. And this will be on the 31st of December. That's for 6 months again. So that 6 plus that 6 gives me 12 at this point. But of the 12 that I paid, 2 belong to the previous financial year. So I'm actually sitting with 10 months on the debit side if I deduct the 2. So at this point, we've got interest accounted for 10 months. That's why if we carry on our timeline and we get to the end of the financial year, we'll realize we're only going to make a payment of interest after the end of the year, but I need to adhere to the accrual concept, so I need to still accrue for the 2 months of interest that is outstanding. At this point, we've paid another 50,000, so our interest calculation will be on 150,000 at 12% for 2 out of the 12 months. And that will give us an amount of 3,000 Rand. I debit my interest expense. I can't credit bank because there's no payment. I'm at the end of the financial year. So I'm going to have to credit my accrued interest. This happens at the end of the financial year. And this is now for 2 months. Can you see if we didn't do the reversal over here on the credit side, I will have 14 months worth of interest expense. And that is not true because in this financial year, I only have 12 months. That's why this reversal will cancel out 2 of the 14 months, leaving me with 12 months that I can close off to the profit or loss account. Okay, this will happen at the end of the financial year, 28 February 20.7. So now we calculate the closing transfer. So if I have 27,000 Rand on the debit side, I need 27,000 Rand on the credit side. So my profit and loss amount will be 23,000 Rand. That's the interest that you've incurred from the start of the year to the end of the year. This accrued interest from the debit will have an influence on the credit side. And now if I balance this liability, I have 7,000 Rand on the credit side. So I will have a balance carried over, brought down of 3,000 Rand in my liability. I do the same with the long-term loan. I started with a credit balance. I paid 50,000, so I will have a balance of 150,000 at the end of the financial year. And we need this information so that we can do the disclosure in the financial statements. You will recall that we indicated the interest expense account will influence my statement of profit or loss. So in my statement of profit or loss, I'm going to indicate under my finance cost, which is a separately disclosable item, right at the bottom, statement of profit and loss at 23,000. So that's the interest expense according to your profit or loss closing transfer there for the 12 months. Then they also ask us to do the statement of financial position. And for the statement of financial position, we've got both the accrued interest, which is a liability, and the long-term loan. And this is the only time in accounting that you have to look into the future. At the end of the financial year, we determined that we owed the bank 150,000 Rand. If a part of this 150,000 Rand will be settled within the next 12 months, that will be classified as a current liability. So I have to split this outstanding loan into the current liability, which is 50,000. That's why we included this in our timeline, and the non-current part, which will be payable within more than 12 months after the end of the year. So this 150,000 has to be included as 100, which is non-current, and then the 50,000, which is the current liability. So in my statement of financial position, you will see that your long-term loan under the non-current liabilities is the 100,000. Plus this 50,000 current portion will give me the 150,000 that we calculated in our timeline. Then our outstanding expense of 3,000 Rand. In our accrued interest account, we ended up with a balance of 3,000 Rand. That will be our trade and other payables. In the note, we discussed that we need 4 items. We need the nature of the liability, and there they tell me it was a loan. Remember, you can also have debentures. That's what I imply with the nature. It was a loan. Then we have to tell the users of the financial statements whether it's secured or not. It's secured by a first mortgage loan over land and buildings, and we give the value of the assets that was given up as security. The third thing we discussed is the repayment terms. It's payable in 5 equal annual installments and when it commences. And then the last piece of information is the interest rate. So this is copying information from your loan agreement with the bank so that the users of the financial statements can also make informed decisions. So for the note, you just copy the relevant given information. I hope that this will be to your benefit and that you will join me again for the remainder of the chapters.